Coming up on today's show, the Trump volatility is back and the AI trade revitalized, equities are back to all-time highs, Netflix earnings, and what it means for earnings season in Q4. And of course, we have to talk about the huge liquidity about to be dumped onto the market. We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500 and the Nasdaq led US stocks higher on Wednesday as Netflix surged to a record high while Donald Trump's boost to AI demand hopes outweighed fresh tariff worries, and we saw big tech rally on the back of the Stargate venture. Oracle was up another 7% today, up 7% as well yesterday. Microsoft just shy of 4%, Nvidia 4.6%. Apple was kind of flat, so too was Google. The standout in the tech space though, Netflix up 9.67% on the back of what some would say was flawless earnings. But all in all, apart from the big names, we saw very mixed price action here in hardware, mixed price action in software. And that was kind of the theme of the market, with a lean towards the red areas. Financials giving some back after yesterday. Retail trade, Amazon held this entire sector up, but we saw Costco, Home Depot, Lowe's, TJX, Walmart. They were all somewhat flattened down today. Commercial services was kind of flat. It was a very mixed day across the board, with some of the big boys leading the gains and some of these smaller stocks taking it on the chin. Net, there was only about 3 sectors leading today. The XLK, the best, up 2.37%. And it really goes to show that if you spur investment in that space, you're going to revive the AI hopes that you have. At a $500 billion US investment, the tech sector really seems to like what they're hearing at the moment. Looking at the communication services, very similar situation, up 1%. The XLI also gained, but it was flat, up 0.07%. Every other sector fell in today's trade, the worst being utilities, real estate, and energy. These are actually like rate sensitive stocks, maybe not so much energy, definitely real estate and utilities right here. And that's because we saw a bump up in yields on the back of some of the tariff concerns we're going to talk about. And net guys, this sums up the entire market. The tech space really leading. You can see that it's actually the growth space, small growth, mid-cap growth, large cap growth. They were all the winners in their respective sectors, right? Although small cap growth just gaining, nonetheless outperforming small cap core, small cap value. That's really what we saw today. The growth trade, the tech trade, any derivatives of AI did really well today. Whereas I saw large cap core was up about 0.5%, and that was the only green we saw today. The worst sector being mid cap value and just value as a whole. That's because financials took it on the chin, and as a result, that's because financials are just giving back some of the gains from last week, whether it be in some of the large financials or even the regional banks. A very mixed day, but all in all, the markets were actually positive. The S&P 500 and the Nasdaq 100, because large cap growth was up 2.13%. But looking globally, we actually saw China and Asia deep in the red right here. And we saw parts of Europe very mixed, as well as South America very mixed. And this was because Donald Trump is threatening a 10% tariff on China. He's also considering 25% blanket tariffs on Mexico and Canada, and is considering an EU levy. And that is why we actually saw a lot of churn in the markets today. It was the AI news. It was earnings weighed down by the tariff situation. That's obviously going to affect the dollar and the yields, and that's going to affect mid cap, small cap, and then the growth trade doing its own thing on the back of earnings and some of the investment we may get under a Trump administration. So all of these gears were working with and against each other to form the trading day we saw. But let's look at some of the market movers. And Oracle up 12% on Operation Stargate. That's going to be $500 billion worth of investment into the United States by SoftBank and a couple of other multinational companies. Oracle shareholders really like this. At one point, they were up like 13%. This is coming off yesterday's strong day, and we did see 7% gain here. And Oracle really performing well so far this year. Netflix stocks reached an all-time high as Wall Street cheered its flawless earnings. Pivotal Research up its target from $1,000 a share to $1,200 $150 a share. Absolutely crazy. Now, the streaming giant reported gaining a whopping 18.9 million users in the fourth quarter. While revenue and earnings also handily beat expectations, it was the biggest quarterly subscriber gain in the company's history. The company also announced a $15 billion stock buyback, boosted its full-year revenue outlook as well as its full-year earnings outlook. The strong gains in subscriber growth came as they had 2 back-to-back NFL games and a successful Jake Paul and Mike Tyson boxing match, as well as the return of Squid Game. All of that meant Netflix gained nearly 19 million subscribers, the most in any single quarter ever. And we saw a flurry of upgrades. This also revitalized the tech trade, great earnings, and I think we're going to see more of the same in the tech space. But Netflix, absolutely flawless earnings, all things considered. Now, a market mover to the downside was Johnson & Johnson. They were down 2.57% and well off their highs right here. And that's because they reported fourth quarter earnings. They beat on the top line, beat on the bottom line. In fact, they reported guidance in line with expectations. But when you actually adjust what their guidance figure was for the US dollar, the stronger dollar, it was actually a revised down. And that's why we actually saw Johnson & Johnson down 2.57%. And yeah, so pretty much inline earnings, but missing the guidance mark on a stronger dollar when you adjust. That is why the stock was down. And I think we might actually see a lot of the same from these type of companies that don't really have a ton of pricing power that they can use to negate the impact of a stronger dollar. It looks like early on in this earnings season, the street is not going to give as much cadence to a stronger dollar because we might be in a state where we have a perpetually stronger dollar and companies will need to adapt accordingly. All in all, we did see market breadth deteriorate. We only had 2,500 advances, 3,700 decliners, with the majority here in the 0 to 2% space. The majority of the advances being the mega cap names, the big tech names, and that's why in major indices, the Nasdaq 100, S&P 500 actually gained today, but the broader market did fall. But when you look at market momentum, things looking still very constructed. Shorter term averages acting really, really well. Longer term averages acting very, very well. Yes, we did see a little bit of a deterioration. Look at the 100-day, we went from 53.53 to 51.4, and very much the same here in the 150-day as well as the 200-day. Nonetheless, very constructive price action, and this is the type of stuff you want to see. You want to see expanding breadth, you want to see market momentum, and you want to see new all-time highs. Those are bull market behaviors, and that's exactly what we got in the S&P 500 right now, guys. We actually did have a weak all-time high, and we are en route close at an all-time high in the S&P 500. There is about 15 minutes before the market closes, and where we stand right now is very, very mixed. The S&P 500 up 0.78%, the Nasdaq 100 was up 1.39%, but the overall market way down by the IWM, the RSP, as well as mid caps and small caps. So really, it's just these big names holding up the entire market. And I do think that is going to continue. I mean, $500 billion worth of revenue is going to come into the tech space over the next year. Market needs to price that in accordingly, especially with these big tech names getting the lion's share of that money. And so that's essentially what's happening right now. It's a repricing of valuation with regards to the new money flowing in via this Trump administration. Now, looking at the actual S&P 500, you can see we actually had a gap up and go. We did see a little bit of selling off the highs. Look at this big wick right here. This is right at the core resistance. We'd actually worked perfectly right at all-time highs. So we'll see if we actually get an all-time high close. Again, still about 15 minutes left for this market to trade, but a very bullish day nonetheless for the S&P 500. And this right here, this is really just looking like a capitulatory low after we close the Trump gap up and we make a move all the way up. We'll see if the market has some firepower to go through and break this. However, we did actually come off the core resistance. We also did see the gamma flip move up ever so slightly. And guys, what these gamma flip zones are is just option market pricing and where the options market will think the market is going to go. Above the gamma flip, you're in positive gamma and you want to buy dips, sell rips, lean bullish, aim for the core wall. Below, you want to just sit through the volatility that we do get in this area right here. Like you can see the volatility that we get right in this zone. You want to sit through the volatility, buy dips, and wait for the market to retake the gamma flip zone. Because the second we get into the gamma flip zone, you sort of get this stair step higher price action and you get volatile price action here in the negative gamma. So that's what you want to do. You sort of want to buy dips in negative gamma, wait for us to get into positive gamma, and then ride the wave out all the way to the core wall or the core resistance. Nonetheless, the S&P 500, it's looking like we might actually close at an all-time high, definitely coming off its lows, but a strong day nonetheless. And I think we just have a slight green day tomorrow, and we're at all-time highs for the S&P 500. Who would have thought we would be here in January after all of the sentiment shifts we saw very earlier on in the year, particularly with the yields? I mean, the 10-year and 30-year yield were approaching 5%. Yields are a bit up today, up 0.59% and 0.25%, but that's because they're about 20 to 30 basis points off their highs. A little bit of a relief rally. We saw a gain in the dollar. The VIX jumped ever so slightly, and the 2-year yield was up. So yes, yield up, dollar up, and it's very easy to see why. Mid caps, small caps, the RSP and the IWM were down. They're particularly sensitive to yields, but the mega caps just brushing off the stronger dollar concerns. If we look at gold and silver now, we did see precious metals increase quite a bit, and I think that's just the market hedging tariff risk. They're getting into these precious metals, gold and silver. Bitcoin was down 1.87%, really owing to the overall risk appetite, the risk-off environment. Natural gas gained 5% WTI in a world of its own, but net, the S&P 500 hitting nearly an all-time high, an intraday all-time high today. Very constructive. And looking at the Nasdaq 100, we saw some very constructive price action as well. The gamma flip, all resistance and put support all moved up today, and we saw 21,420 is now the gamma flip, which means there's a little bit more upside. The options market wants to see the Nasdaq 100 go ahead and take out those all-time highs. That's exactly where the core resistance is, and that's sort of similar to what we would see in the S&P 500 if you look at it visually. But the Nasdaq 100 poised to go higher. I think we probably do move a little bit higher into the end of the week to close out this gap we saw here in the S&P 500. Nonetheless, this move that we saw, this deep move, looking like a real move to the upside. And I think the market is real giddy up upon that $500 billion Stargate investment. And I think we're going to see much of the same, particularly with earnings season. We have earnings, the fundamental picture, and the technical with liquidity, all giving demand to these mega cap names. So we really do want to be long or want exposure to these mega cap names. We probably will go higher, not without some volatility, don't get me wrong, but we probably will go higher. And we could definitely see here that, these smaller names are certainly sensitive to risk. The RTY came off. However, when you look at it on a technical basis, though, it came right off the core resistance. We didn't get a move up like we were expecting to yesterday. In other words, so we do need to look to find a bottom as we do find a bit of weakness off this core resistance, right? That bottom could be here at the gamma flip. It could be anywhere in between where we are right now and the gamma flip. But once we find this bottom and we do see a move up in the core wall, we probably go higher. But for now, the Russell 2000 acting very, very strongly. This is exactly what you want to see after the monster gains we got yesterday, right? Like, you just want to see a bit of consolidation. That's actually very, very healthy. And that coincided with some of the yields moving up. So if yields had to move down tomorrow, maybe we get a slightly weaker dollar, we should see a little bit of a pop in the IWM as well as the broader market. But if you actually look at everything, right, we went from peak to trough, nearly a 7% gain in the Russell 2000. I think it's time for a little bit of consolidation, and that could last through the end of this week. But a bit of consolidation is due, especially in something like the RSP. We take a peak to trough reading, right? The RSP up 5.8%. There's nothing wrong with a bit of consolidation, a little bit of a pullback, and then make our next move higher. That's actually healthy market momentum. All in all, I think equities look very, very strong. We're seeing constructive price action in the IWM and the RSP on a red day. We're seeing very bullish momentum in the S&P 500, notching all-time highs, coming off its highs a little bit right now. The Nasdaq 100 looks strong. Everything looks strong. I mean, you have liquidity injections, you have earnings injections coming soon. There's a lot of positive catalysts for large caps at the moment, as well as mid caps and small caps. All we need to do is continue to see a move down in yields as well as the dollar, but mostly just the yield. And I think we're going to see the IWM and the broader market act very, very strongly. Nonetheless, guys, I'm aiming for new all-time highs in the Nasdaq 100. I'm aiming for even higher highs in the S&P 500. And I think we should see continued positive momentum in the RSP and IWM. In fact, I think those spaces probably are going to see relatively more upside in the S&P 500 and Nasdaq 100, relatively speaking. Nonetheless, guys, I said to buy the dip in early January. Those that did are sitting handily on gains. Those that didn't are still asking why. Nonetheless, I do think we go higher, but not without some consolidation. So if we do get a consolidatory dip, buy that dip, we will go higher. I think we see new all-time highs in the Russell 2000, Nasdaq 100, as well as the RSP before the end of this quarter, so buy the dip.
And let's talk about sentiment. This is the weekend poll we do every single week. And this week I asked very broadly, how are you feeling about stocks heading into this week? Now, 780 of you voted, and the overwhelming majority, 2/3 of you, said you were bullish. Really, this is what you see in a bull market, guys. You see bullish sentiment and a very clear lack of bears. Only 90% of you guys on this channel are bearish, and 13% of you are neutrals. Now, the overwhelming majority of you guys are bulls simply because you're probably looking at stats like these. You're looking at S&P 500 earnings growth, and when you see the Magnificent 7, which account for 30% of the S&P 500, is going to grow at 21.7% for Q4 2024, and you actually have the other 493 growing at nearly double digits. This is according to FactSet. You're going to take these stats and you're going to say, hey, I want to be long risk assets to capture some of the upside if we do see a lot of earning beats. And that's exactly what we've seen as of late. In fact, so far for this earnings season, beating analyst estimates is paying off more than usual for stocks. In fact, stocks that are beating both sales and earnings estimates are seeing an average gain of 3.34%. This compares to the historical average of 1.5%. So management teams that are beating earnings expectations are getting handsomely rewarded. Now, do take this data with a grain of salt. Only 43 companies in the S&P 500 have reported so far, most of them by the big banks. However, it's still data that we could look to right now. And the reason why I do think that this is going to continue is because coming into earnings season, expectations weren't so lofty. They weren't that high. If you actually just exclude communication services, we saw downward revisions in every single sector, with the majority of them coming from energy, materials, healthcare, with the S&P 500 seeing an average downward revision of 2.7% heading into Q4 earnings season. And this type of stuff leads us to big upward surprises, because when all you really have to do is meet your expectations and then you come in and beat, that's going to lead to plenty of upside surprise in every single sector, maybe excluding comm services. And this is the type of stuff you see in a bull market, guys. You see upside earnings surprises, you see earnings growth, and you see downward revisions that tend to get beat. What you also see in a bull market is expanding market breadth. It's not often you see stocks breaking records dating back to 97 years. That's exactly what the S&P 500 did this week. This is the 6th straight session with 2 out of every 3 stocks in the S&P 500 advancing. This is very bullish behavior, and it probably is a whole range of things. It's probably the fundamental picture, the macro picture, and also the market giving a little bit of onus to Trump and his business-friendly administration. But when it's all said and done, guys, don't discount the fact that we are in a very volatile period of the year, particularly in a post-election cycle. Here around the inauguration into the start of a new presidency, we tend to see a lot of volatility, don't get me wrong. And while we do see upside, we also do see downside. And net, what you really want to take from all of this is that we generally trade sideways for the first 90 to 120 days of the new administration, and that's when we go onward and upward. So guys, we could see the next 2, 3, or maybe even 4 months of sideways action, potentially downward action. However, it's an opportunity to buy the dip, because history tells us that we do go higher in a post-election year, and this is led by gains we see in the back end of the year. But all of this pertains to the fact if the macro holds up. And right now, Goldman Sachs lifted their Q3 GDP forecast. It went from 2.3% to 2.6%. They lifted their forecast by 0.3 percentage points or 30 basis points. And that had to do with some of the economic data that we got in the last couple of days. However, guys, there is a bigger macro theme with regards to liquidity that's taking place that we really need to talk about. Now, the US government will hit its self-imposed debt ceiling of 36 trillion on Tuesday, January 21st. That was yesterday. This means the Treasury can no longer take on additional debt until a new debt ceiling agreement is reached. This has historically involved raising or suspending the ceiling. This doesn't mean imminent default, however. The Treasury has, and I quote, extraordinary measures that it can use until lawmakers eventually agree to a new debt ceiling deal. One of those measures is to dip into the Treasury General Account, the TGA, the government's bank account at the Federal Reserve. The TGA balance is currently a sizable $650 billion. And when the government uses cash from the TGA to fund spending, it is effectively an injection of liquidity into the markets. This is because when money is sat idle in the TGA at the Fed, it is essentially removed from markets. But when it is spent down, it is released back into the markets, an injection of new liquidity. In the past, significant TGA drawdowns have coincided with asset price appreciation. Look at here in 2021 throughout 2023, and this is where we are right now in 2024. The TGA drawdown in 22-23 started halfway through a bear market, and it was arguably one of the main factors in halting that bear market. Some people even argue that debt ceiling episodes and TGA drawdowns have an even greater impact on asset prices than quantitative easing, because there is also no new debt issuance or the duration of the debt ceiling talks. So the short and dirty explanation of what I'm trying to tell you here is debt ceiling debates are going to happen. They're going to be protracted. That means the Treasury will be forced to draw down the TGA imminently, and this means there's going to be a flurry of liquidity into the system, particularly once a debt ceiling deal is agreed upon. And expect this to move down, and it's going to coincide with asset prices lifting, and that could possibly result into a blow off top. Look at what we did here at the end of 2022 into 2023, and then here at the end of 2020 into 2021 with the everything bubble. As you can see right here, guys, as well as right here, this is when we hit previous debt ceilings. So the TGA normally gets spent out during these protracted negotiations, and markets actually benefit the most out of it. You see, markets like to climb the wall of worry. That's exactly what these negotiations are, simple worry. With the added liquidity, markets will move higher. Now, looking at earnings, guys, so we've had a crazy week of earnings so far, but it gets even crazier. Tomorrow, we have GE Aerospace before the open, American Airlines, Huntington, Texas Capital Bank, Elevance Health, Union Pacific, and the Bank of California. After the close, we have Texas Instruments, Intuitive Surgical, CSX. And that's really all I can see here. And then we have a couple of big names on Friday, but a big day of earnings, another big day of earnings tomorrow. And then looking at data for the rest of the week, we only have initial jobless claims. It's not really going to move the market because we know it's probably going to come in line. It might miss, it might beat, but it's not going to vary significantly from this figure right here. And then on Friday, guys, is when we get the PMIs, but we'll talk about that tomorrow and our expectations. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like